Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the weekend edition of the KE Report. Cory and Shad here, your host for this weekend show. Bit of a different weekend show here because Shad and I were in Las Vegas at the Money Show, and we had the stage actually for quite a while with a roundtable, a couple company presentations, as well as a quick take re-recorded live from the floor of that Money Show. So the first half of this show is going to be a replay of that quick take. I took out some of the beginning parts where we did a poll of the audience and more of an intro to the show. This is more of a overview of our thoughts on metal sectors. We even get into energy, but again, overall, it's high level, where we're looking, where we're seeing opportunities in the metal space, and especially in the stocks. And then in the back half of the show, we're going to switch exclusively to the energy sector with Dan Steffens. So everyone, I hope you all enjoy this KER quick take from the Las Vegas Money Show. Let's get into kind of a broad look on commodities and the commodities market.
Well, I think one of the themes we wanted to get across to people is that in 2020, during the lockdowns, the world changed, as everybody knows. But what changed is global supply chains, how people looked at how they sourced their raw materials. And we've really started a commodity supercycle in 2020 going into 2021 coming out of the reopening. And you can see around the world initiatives in the US and in Canada, in Europe, in Australia. Everybody's trying to lock down their own supply of critical minerals. And so there's a lot of strategic initiatives in place by countries to expedite the permitting, expedite the development of projects. There's funding available from governments now, which we've never seen in decades in mining. So it's an exciting time to be in the commodity sector. And if you look at most of the metals, whether it's gold or silver, platinum, copper, look at lithium, look at uranium, all the specialty metals, rare earths, tungsten, antimony that they were just talking about, you're seeing a surge in metals prices. And that's because countries realize and manufacturers realize, hey, if we're going to get our hands on this, we need to lock it down now. And that's caused a price response in the market. So one of the things we're going to dig into in this talk is, in light of the commodity supercycle and in light of the metals market being in a bull market, it's kind of time to make hay while the sun's shining.
Now, I think we all know it's a different story for different commodities. There's precious metals. We'll get into the precious metals, base metals, critical minerals, and all these energy metals. All have different drivers. All are being driven by a pretty similar theme right now, as globalization is on the decline and governments are way more focused on where they're getting their metals from. Prices have responded. The other aspect that we're dealing with that is different than in the last 10 years is we're in a CapEx build out right now. Yes, it's focused on AI. We hear all about AI at this conference. Fact of the matter is, there are some very big tech companies putting to work a lot of money to build out actual infrastructure. 10 years ago, it was all about software. Software, commodities don't really benefit from that. Right now, commodities are hugely benefiting from this data infocenter build out. There was a stat that one of these data centers takes up as much copper as you need for almost 300,000 homes. So if you put that in perspective, we have multiple data centers being built out. These are a fundamental driving factor for the base metals, but then there's also precious metals. And the precious metals narrative has been one that I'm sure if you have followed along, and it's been all over the news because the best performing assets last year were precious metals, gold, silver, especially at the start of this year too, and the underlying equities. It's not just one reason why this is going up. Fact of the matter is, a lot of people are, and a lot of investors are diversifying their portfolios and including precious metals and the precious metal stocks, right? Gold was $1,000 10 years ago. It's $5,000 now. It was $2,000 a year and a half ago. It's $5,000, over $5,000 now. Silver, that's been an absolute wild ride. So we'll get into each commodity sector, the big ones mostly, and get into some of the stocks. I'm sure you all want to know some of the stocks that probably will benefit or should benefit further from this. One final comment I would make about this commodities bull market is that, look, a lot of easy money has already been made. You can look at these charts over the last 2 years, and you're going to see a hockey stick shape. These stocks are up 4 or 5 times. It doesn't mean there's not upside left, but you need to be a lot more selective right now. Last year, you could take a shotgun approach. You could buy almost anything with gold, silver, copper in its name. You're up 2, if not 5 to 10 times. Now it's a different game. There are companies that are making so much money, but there are companies that don't have anything, won't have anything, and have gone up 5 times. So you need to be a lot more selective.
Well, and I don't know what the background is of investors here as far as the companies, but there's really 3 or 4 flavors. There's the producers, people that are pulling the metal out of the ground. Their revenues have gone up substantially based on the gold and silver prices. There's the developers that have ounces in the grounds defined, maybe some economic studies, and they're the next mines in the batting order. There's some optionality there that can be played into. And then there's the exploration stocks where they're drilling to find the new deposits. And so we can kind of give you a flavor of each of those categories. There's also royalty companies that get paid, cash a check every month, and they're holding assets on a number of different producing companies. And when those companies produce, they get a cut of the action. So kind of a couple different ways to play it. But just one more thought on gold too is, why is it going up? Why is silver going up? A couple reasons. One is your purchasing power and your fiat money is going down. So it's a debasement trade. Gold hasn't changed. It's a rock. It's on the elemental table. Nothing's changed for thousands of years, millions of years. What's changed is your purchasing power, whether it's in the US dollar or the won, or whether it's in yen or whether it's in the euro, is losing purchasing power. Hence, there's a rise in everything else. It's also the slow, insidious nature of inflation. But what's also happening is central banks are buying gold. You see crypto companies like Tether coming in and buying as much gold as small countries. You see retail investors in the East and the West joining into the party here and buying not just the physical, but also digital assets that hold the physical. Now there's gold-based tokenized assets. So there's a lot of action here. But one of the highest torque areas to play is in the mining stocks. So just a couple thoughts on gold just to kick us off, but let's maybe get into the equities.
One theme I think you're going to hear from us is that we're in a great pricing environment. We all know that. And as much as people around these conferences and everyone will try to tell you where the future price is going, we don't know. So if you're in production now or in production within, let's say, the next year, you can actually take advantage of these prices. Because one thing that you're going to see when you dive into some of these companies is projects that didn't make money 3 years ago or 5 years ago. They make money now, and they've been taken over by new groups that are benefiting from this, but there is no guarantee on these future cash flows, right? So you need to see companies that are in production right now or have a pathway to production. Also on the flip end of that, we're not seeing the M&A. The M&A hasn't come down to the juniors, which can be a good sign. It argues that we're not late cycle, but it also means that you don't have that quick exit out of a junior. So the stocks that are producing, that are making money right now, are clearly the best ones to be in. That's going to be a no-brainer. Yes, you can get some of these more speculative plays. They might do well too. If you want any margin of safety in this market, it is in producers or those that are cashed up and will be in production very soon. Quick little recap in terms of gold. Gold corrected at the end of January, almost 20% in a matter of a couple days, maybe a week. It has already recovered quite well. Gold is in a fantastic situation price-wise and even chart-wise, but all we keep hearing is we're going to need some time to digest this massive move that we've had. Maybe we will. That is the consensus right now. The upside risk is that if gold breaks to another all-time high, and we can talk about all-time highs, just like we were doing almost every week last year, that brings all the generalists back in. We have a bunch of generalist traders on our show, including Mike Larson, that were riding that wave all last year. There was a lot of new money that made money in the sector last year. And now, from our talks over the last 3 weeks, just to the guests that we have on, they're all on the sideline. They have small positions, but they have taken their profits and they're watching. They're not negative on it. They're just waiting. It's a momentum play. Right now, momentum was lost all in one day, which is kind of crazy to think about. But when you have that parabolic move, this is what happens. Now we've set up wide trading ranges. This is why we will keep harping on the producers and companies that are making money, because the financing window that we saw open up in the last year was historic. The amount of money that flew into these companies paled in comparison to any other bull market. So now all these companies have money. They're not coming back to the market. We will have a lot of shares coming free trading over the next couple months, but the market's okay with that because these stocks have done so well. So it is, again, so stock selective. And whether you want the big guys, the big producers, they're doing well. They're not offering you the growth or, quite frankly, dividends. Their dividends are very small. They're not returning capital to shareholders. They are your safer bets. It's these mid-tier producers that, one, could have growth, and two, have smaller mines that all of a sudden are making a lot of money. And these companies have small market caps when you think about the global world.
Yeah, just to piggyback on that, I think that if you look at a lot of the stock charts over the last, let's say, 6 to 7 years, you see some of the larger companies started moving a while ago, really in 2018. Companies like Lundin Gold, Wheaton Precious Metals, Agnico Eagle, they all started moving. They've been running for years. So in that standpoint, that first wave has already happened. What we saw the last 2 or 3 years is that the mid-tier producers started moving. Things like the Equinox Gold, if you're familiar with that, or some of the companies that, well, America's Gold and Silver that was just on here doing silver and gold, now antimony and copper, they started moving a couple of years ago. What started happening over the last year is that even the small guys, even the ones that were the higher cost, and so this is an important note, the leverage that you get on a high cost producer is amazing in a bull market. And here's why. On a percentage basis, their valuation, their margins expand quicker than the big companies. If you're Agnico Eagle, you're the best gold mining company on the planet. If you're a smaller company, some of the companies we have on our show, like Mako Mining or Thor Explorations, they're smaller companies, but they've gone up 4x, 5x, 6x just in the last year because their margins have expanded the most.
Heliostar, too.
So Heliostar bought the San Agustin mines from Argonaut, and those were high-cost, old, tired mines. They turned their operations around, and they're going to plow all that money into their development projects. Integra, that I was thinking of, bought Florida Canyon, but they're going to plow all that money into their Delamar project and their Nevada North project. So if you look at the batch of small to mid-tier producers, I think that's where the opportunity is now, because they're the ones that are going to see the big jump. And just one final point. If you look at Q4, the numbers that most companies are putting out, they were doing $4,200 gold and silver around $55. Well, look where prices are now. We're north of 5,000 gold. We're in the 70s and 80s for silver. Today it's like 86 or 87. So think about the step change that's going to happen between Q4 of last year and Q1 right now. We're 2/3, as we sit here, 2/3 through this quarter. What are these numbers going to look like when they report them in May? I think it's going to turn some heads. I think analysts are behind. I think a lot of people are asleep at the wheel on this. And if you can get in the stocks now over the next couple of months and get positioned on pullbacks, when they report Q1 earnings, you've got a chance to benefit as an investor.
So to the point on that one too, these stocks have already done well. Ones that made acquisitions last year, 2 years ago, look for them to keep doing stuff. If they stand pat on these numbers, then they don't offer that growth, and you're going to have better opportunities out there as well. So again, kind of sniper approach, not shotgun approach right now, because again, you look at any stock chart, you're going to think it's totally gotten away from you. But understand that market caps in this sector are still in the hundreds of millions of dollars, not in the multi-billion dollars, which is room to run. Silver, okay. Silver, not a totally different story, but I think Shad and I have a little, we sometimes go back and forth. We go back and forth on this a lot. Silver, great run, obviously, right? It went from $30 last year to $120, and it went from $50 to $120 in a month or two. It was an insane run at the end of the year during thin trading markets. I personally am a little bit worried about the silver market. I think that it's going to be very hard for silver to get back up into 120 range in the near term. I hope it does, but I think silver you need to be a lot more selective on and understand that silver, it's volatile. It's moving $20 in a week or two these days. It used to only be worth $30. So silver is much more a trader's market, I think. If you're getting into the stocks, you need to select the ones that are in production and making money, because one thing that we saw is that even as silver went up from $20, $30, $40, $50, these companies still struggled to make money, the small ones. It was amazing. It was $40. You guys have to just be killing it now, right? You must be making bank. And they weren't. So silver is the tougher game. You do need to understand that costs are going to go up as metals prices go up because they mine lower grade material. That is what they do. It's actually good management in that sense, but it just means their margins don't expand the way you expect them to. So again, silver, I'm not going to talk too much about it because I very much personally, my portfolio in a wait and see position. A lot of my silver stocks I'm free carried right now because they've gone up so much. So I've sold my initial investment, if not more than that. I'm sitting in them to see if silver does shoot back up. But there's also an argument that silver might pull back and these stocks will struggle. So my take on silver and what I'm doing in silver, I'm not diving into any of these aggressively right now unless they have actual catalysts and they've done something out there. If they're standing on their assets, to me, we're going to need to see what the silver price does because that's what's going to lead it.
We're going to do a good cop, bad cop thing here because I'm more bullish on silver longer term, but I'm also in about 20 silver stocks. So I'm going to put my money where my mouth is on this one. I think that the run that we saw up to 120 was a bit parabolic and it needed to correct. I was surprised at how much it corrected down into the 70s. It even got to 64 on the futures market before bouncing back. So a little bit of a wild ride. But again, if you think about where the silver producers were last year, they were in the 30 to 50s. Now we're hitting the 70s and 80s just here in the first quarter. And I believe that even if we stay anywhere around here, these companies are finally going to be more profitable. An important nuance with silver companies is a lot of companies that have silver in their name aren't silver companies. They're silver companies in drag, but they're really base metals companies. They're really zinc companies, copper companies, lead companies that have a sprinkling of silver. So what you want to find is companies that have at least 40% silver or more in their metals mix. I like seeing 50%, but it's hard to find. So if you can find a company that has 40, 50, 60% silver, you have more leverage to silver. The reason a lot of companies weren't doing good when the silver prices went up is they don't have much silver. Even Pan American Silver only had 19% silver before they bought Mag Silver last year. Now they're up to 27%. So you want to find companies that have more silver to give you that torque. The ones that have the most leverage are the ones that have the most silver. Now, is it volatile? Of course it is, but you want to look for companies that are trying to control their cost. And I think an important thing to look at that the market rewards is growth. Companies that are adding a mine, companies that are developing a different part of a mine, a higher grade area, somebody that can go in and high grade a portion of the area and really push the gas pedal in this market, companies that can make acquisitions. So you want to look for growth in this kind of a market, and I think you can be rewarded as an investor for looking for growth-oriented companies.
We do need to talk about the Mexico risk that is clearly in the news right now. A stock that we follow, that we know very well, Visa Silver. It is not a good situation right now. And we also have Puerto Vallarta. Good thing this conference wasn't taking part in Puerto Vallarta right now. We would be all talking about something different. So there's definitely jurisdictional risk for silver stocks in Mexico because so much silver is in Mexico. These assets can still be world-class. They can be delayed. They have a more friendly government to mining right now, which is a big change from just a couple years ago. So there are positives there, but jurisdiction-wise, there are different states that are better than others. Unfortunately, some of the best deposits are in those very bad states. So on that note, this also just speaks to trading. If the stock has gone up a lot, sometimes take some of your money off because you can be blindsided by certain Mexico news. But the best deposits are in Mexico. There are some very good deposits in the US as well. So I do think we will see a bit more of a shift of focus if silver stays on everyone's radar to some of these US deposits. But there are good Mexican deposits. These are good assets, but you do run some jurisdictional risk.
Yeah, 100%. You have to know that you're working with teams. And I think it helps if their teams are based in Mexico, managed by people in Mexico and operating there, providing jobs to the local stakeholders. It doesn't mean it's foolproof, but a company that's done incredibly well that we have on the show is Avino Silver and Gold. They've been operating there for decades, and they're entrenched with the local communities, and they haven't had any issues. The company that I flagged as the number one pick last year, it's already run a lot, but I still think there's upside, is Santa Cruz Silver. They have one mine in Mexico, their Zimapan mine, but the rest are in Bolivia. And a lot of people hear Bolivia and think, oh boy, I don't know. Well, they've got 5 mines there. They've done incredibly well, and they're up. They were the number one stock on the TSX Venture Exchange last year, and they were one of the top 50 on the OTCQX. So that's a company that's diversified into South America. There is a lot of silver in Peru. There's a lot of silver in Chile. And there is some in Canada, strangely enough. There's some companies that are working on developing projects in Canada. Maybe we could shift over to developers because there's a couple good names coming down the pike. And there is also some U.S. assets. You just saw America's Gold and Silver there in Idaho. There's about 6 to 8 companies in Idaho, including Hecla, that's a solid operator domestically. Core Mining is operating a lot in the U.S. So you can find U.S. and Canadian companies, but a lot of them are Latin American plays. There are a few European plays, but I think we'll stray away from those and just focus on North America for this talk.
Actually, one other from South America, Abra Silver. That one is fantastic. That's Argentina, and Argentina is its whole other story that has changed. Anyone who's followed the resource sector or Argentina, it goes in 7-year cycles, so it might come crashing down in a little bit, but right now, Argentina is the place to be. North America, there are some good ones. I struggle with some of the development costs in North America too, especially when you get into the Golden Triangle. It's very, very expensive up there. But world-class deposits. I'm also from BC. I'm from Vancouver. And BC, it's West Coast. They're not overly friendly to mining, but they are warming up to it. There's been some news recently, especially in the copper space that we'll get to, that they are fast-tracking projects. But yeah, look, there's opportunities. Do you want to share any more on silver, or should we move on?
Well, you brought up developers. So Abra Silver is a development company. They are working on getting their final feasibility study. There's a thing in Argentina, the RIGI laws. If they get that in the next couple of months, that's a big catalyst for them. So even though it's gone up a lot and it's been a top performing stock, it could still go higher on those catalysts. You brought up British Columbia. Dolly Varden Silver is merging with Contango Ore. Dolly Varden is a great British Columbia silver and gold play, now merging with a gold producer in Alaska. So it's kind of a weird mashup here. But they're going to have the production money to help fuel their development. And so that's another idea for you. As far as other development projects, there's a lot we could get into, but one of the companies that I like that's got a permit in Mexico, we talked about the challenges, is Silver Tiger. Silver Tiger is the first company to get an open pit permit in the last 6 years. And I think that's because they have a good social license. They're going to be building a open pit gold forward project with some silver, and then in tandem over the next couple of years, developing underground silver deposit. I actually was just talking with the CEO earlier today, and so I'm pretty excited about Silver Tiger as a development stage company. You are taking on Mexico risk, but again, they just got permitted by the government, so I think that's a good step forward. So that's just a couple ideas for you on the silver developers.
I like Silver Tiger too. I think that's a good one, and I think they're, for the most part, cashed up. Yeah, sure. Let's go to copper. Copper actually is one that I'm the most encouraged by. I think the copper chart hasn't gone parabolic by any means. It is a nice steady climb. The infrastructure build-out that we're going through right now is unlike anything we've seen in the last 10 years. Copper did really well back in, let's say, 2004 through 2007, about 2006 actually. Copper went from $1 to $3.50. It was a big build-out. The US was building houses. China was building out their infrastructure, and then the world switched. We went to software, we stopped building out, and now we're back to rebuilding. And there is no substitute for copper. As long as it keeps moving this slowly, it is still a very useful metal, and it's used in everything. So I do really like the copper setup. Plus, it just ties into everything that the current administration and all other governments around the world want, in all fairness, is they want copper, they want to build out domestic supply. There's a lot of good US, or not a lot of good, there's only a few, I think, good US copper projects out there. There's some in Canada as well. There's a lot down in South America as well. One thing I would caution is that one of the narratives behind copper is this whole supply demand. And you look at these people's charts that show supply continuing to increase. I agree with that. Supply has done that. That is what history has told us. But then, demand continue to increase. Supply, though, they just have it dropping and flatlining. That's not what we see. These miners are able to get more out of their assets. They can keep them going. And at these current prices, it still is not incentivizing a whole lot of copper companies that aren't producing to build these mines because the price tags are so high. As the price moves up, I think we will see more building, and I think we will see governments help out on the cost front. But right now, I think copper is where you should be looking when you're looking at the stocks, because the gold and silver stocks, they all went vertical. The copper stocks have done well. They have not nearly put in the same moves that gold and silver have. And I think I just like the setup better. One thing to also realize is that copper got to $4 in 2011. It took 10 years until it got back to $4. It only went down, and then it rebounded in 10 years, and now we're going to $5. Now we're climbing to $6. It's a nice gradual rise. More people are paying attention to it. But again, these high prices, there's no substitution that anyone would come up with. It's still relatively a cheap metal. And there haven't been a ton of major discoveries, so you can really isolate the good projects out there and say, this has, right now, too, government approval. It has a defined resource. It might just need money to build, but money's more available right now. So I really like the copper space. To me, I've moved a bunch of money into copper stocks. I think that has the best setup. And the copper majors have done well, and they've done well for a while. They've built up cash. And all we're seeing is gold companies look to buy copper companies too. So there's a much wider audience to actually buy out some of these stocks too.
Yeah, I really like copper too. And to the point you just made about gold companies getting into copper, there was just a transaction in the marketplace where Eldorado Gold is buying Foran Mining. Eldorado Gold is a gold company, but they're buying Foran Mining, which is copper, zinc, and polymetallic. And so you've seen Barrick Gold say that they want to get into copper. You saw Newmont buy Newcrest, which had a lot of copper assets. So there are a lot of crossover between gold and copper right now. And even in the royalty companies, some of the royalty companies have both gold and copper assets. So I'll throw out some ideas for folks as investors. The ETF that follows the copper producers is COPX. It's a great way to play the sector without taking an individual company risk. So COPX. There's also, for the juniors, COPJ. So just a little bit smaller cap companies. I would also recommend as an investor to dig into those ETFs and see what they hold. What are the main companies in there? And then dive into those companies individually. It's a great way to do due diligence. A couple producers I'll just throw out that I think are quality. Southern Copper is a good company. I just met at the Vancouver Resource Investor Conference with Amerigo Resources. It's one that I hold in my portfolio now. It's a single asset copper producer in South America, Amerigo Resources. But the risk of being a single producer is if that one mine goes down, you got risk there. But they've been operating for a decade. They're solid operators. And a small company that we have on our show quite often, Magna Mining, they're in Sudbury in Ontario. They've bought a producing copper mine. They're developing a second and third copper mine right now that are going to come online in 2027 and 2028. So if you think copper has longer term legs to run from the $5 and $6, maybe up to $7 over the next couple of years, I think Magna Mining is a great way to play it. As far as U.S. assets, Arizona is the state you want to be. Arizona is where the copper is in the U.S. There is some in Nevada as well, and there's some in Idaho, but really Arizona is the copper state. I'll throw out three names. I'll just throw out two names. One is Arizona Sonoran Copper. They're a development project right next to Ivanhoe Electric, run by the infamous Robert Friedland, who talks about copper all the time. And they have a very good advanced stage project moving forward. The other company I would mention is Faraday Copper. They just raised a lot of money, or they're raising a lot of money, but they have a solid asset, kind of a land bank of different copper projects moving forward. And they're drilling 40,000 meters this year. So kind of an exciting play in the U.S. So both Arizona Sonoran and Faraday Copper are two good development stage copper stories in the U.S.
Yeah, Faraday just made a really cool acquisition too, that in a way almost changes them from a smaller potential producer to a major almost producer. But that's another story to take a look at. A lot of these companies too are going down this Fast 41 area. But then also there was news out, I believe it was earlier today, at the North Isle, Copper and Gold, or Gold and Copper. They just got fast tracked, or they are going into the fast track in BC. So there are a few copper assets out there. The copper explorers, the junior copper plays, I would warn you to not go all in on those. That is more of a risky play, simply because of how expensive it is to drill out copper assets. It costs a lot of money. It costs a lot of time. Depends on your time frame, and also, again, there just isn't that environment right now where I think you need to go into the smaller copper plays. I think the mid-tiers are where you should be, and again, the more gold companies come over to the copper space, the more money you have coming back into the copper space. Critical minerals. Now, these have been all over. It almost feels like every mineral is now considered critical or strategic. Every government is moving on it. It causes a quick bump in some of the share price. Sometimes the US government even invests in some of these companies. That runs the stocks higher, but we do see them turn around pretty quickly too. These are tiny markets, and they're very hard to do true fundamental analysis on, because one or two mines can change the overall supply demand. And quite frankly, a lot of these metals, all of a sudden, when the price goes up, we hear about gold companies, copper companies, silver companies saying, we actually have that too. So we could produce that. We'll move into that sector. It does well for the marketing wise, but I do think that when you get into the critical minerals, you need to figure out how to become an expert at them, or find, again, ones that are already in production that now can tack this onto their production. When you have a company that's already making money producing gold or silver or whatever it might be, and then all of a sudden they have a whole new revenue stream that is almost free money to them, these are the ones that are going to be benefiting, because these are the ones that companies are, or countries are looking for, saying you can provide us with that supply that we need right now, rather than potentially drill it out. And again, you don't know what kind of cycle you're in. The more you invest in resources, the more you realize that you need to take advantage of the bull market cycles that are here and now, not the ones that could be coming, because they could be a decade out, and it's dead money in that time.
Yeah, and I think critical minerals is such a big basket, it's hard to get your arms around what you mean by it. Lithium is a critical mineral, and there's lithium phases that go up and go down. Uranium is a critical mineral. It's gone up and gone down. You need both those for power, either the battery power or nuclear power. But there's also things that come into vogue like rare earths. How many times have we heard about that over the last year, especially this government dealing with China? Antimony, tungsten, which are defense metals. There's so many different minerals, it's easy to your head to start spinning. So I think the safe bet in a lot of these is to find a producer of those metals that's been in them for a long time. And again, I'll throw out some ideas and names just to give some people some due diligence homework. If you're looking at something like uranium, there's some companies here in the US like UEC. They're a producer, but they also have a big development project in Canada. So UEC, Uranium Energy Corp. There's Encore Energy. They're a small producer in the US, and they're just spinning out a company out of their assets to really focus on their production and let another company deal with the exploration. So Encore Energy, another solid producer. And I'll give you one more for uranium. UR Energy. It's URG on the big board, but they're a smaller producer that's adding in a new mine this year. So that's some ideas on uranium. Now, can you play developers and explorers? Of course, but like Cory said, you're taking high risk, and it's better to go with the companies already producing. If you want a Canadian major, Cameco is the big company. That's the big boy. But you could always invest through ETFs in these. So if you want an ETF for uranium companies, you can look at URNM or URNJ for the juniors. And then there's also URA, which is a big kind of nuclear power and uranium one. When you look at the smaller, more niche metals like the antimonies, America's gold and silver that was up here is unique in that they're not trying to be a me too. They already have antimony. They've been mining it for 20 years. They're just going to get paid on it now, which is a nice change, instead of getting penalized on it. So that's a plus. But there's very few antimony producers. The thing I would focus on is staying away from drill plays or people that say, hey, we have this mineral, focus on the people that produce it. I can't think of any other producers other than Alkane Resources, which is in Australia, and they produce antimony. Other than that, there are no antimony producers. For rare earths, just a couple quick names. MP Materials is one of the companies the U.S. government invested in that Cory was alluding to. So it spiked up, then it crashed down by 40, 50%. Now it's heading back up again. But if you have government money coming in, you're probably a little bit safer than the one that doesn't. I'll give you a name that I can't believe they haven't invested in yet, and that's Neo Performance Materials. They produce rare earths. They produce permanent magnets that you need for defense and for electric vehicles and for fighter jets. And Neo Performance Materials can separate these 17 crazy minerals, and I think that's a good name to look into. That's more of a slow and steady wins the race. And I'll give you two other ideas here. Tungsten. You hear about it a lot, but how do you play it? Almonty is a producer of tungsten, but they're a Canadian company with a U.S. big board listing operating in Korea. So I don't know if you want to take that kind of risk, but Almonty has gone up quite a lot because the tungsten price has gone vertical. I'll give you an idea domestically. American Tungsten. They have been on our show before. They're a development project, a brownfield site that's working to get into production in the next year or two. And then rounding it out here with lithium, I'm going to throw it back over to you because you talk to more lithium companies on the KE report than I do, maybe a couple lithium names.
So the lithium names that I really like, or the ones that I try to focus on, are ones that are actually proving out DLE technology. I think there's a lot of lithium out there, but I think DLE technology unlocks so much more and makes it all economic. So one that's done well recently is Liberty Stream. They are operational in the US. They're taking wastewater from oil field brines and turning that into lithium. It's a very interesting play. They've been at it for a few years now. They're scaling up their field pilot plants. I don't even know if they're calling them pilot plants right now. It's technology in the resource space, and it could very well, it seems to be working. The market is taking notice, but this is still not a big company for if it unlocks DLE technology. We saw Exxon Mobil. They are putting so much money into DLE technology. If they can buy one of these companies that has proven it for oil field brines, unlocks the whole sector. There's a lot of other companies out there that have lithium deposits. It actually doesn't take much to drill out a lithium deposit. You can put 4 or 5 holes in a project and come out with a resource. The problem is then everyone has a resource, and it's hard to value them because they have no path to production and, quite frankly, no takeovers. So for me, it's focusing on the DLE technology. Again, I think Liberty Stream is above that, but I like their strategy of going to existing oil fields and simply taking their wastewater and turning that into something. There are a couple others out there. I hesitate to recommend a lot of them because it's such an opaque area. Everybody says that, or a lot say that they're in pilot plants right now. And if you even talk to these people and ask for a picture of what their pilot plant looks like, it's a little shed. Like, this isn't real production, if you ask me. It's when they start to scale that it looks more interesting. Yeah, that's all I have to say on lithium is I'm focusing on the DLE technology. And if you find another company that is advancing DLE technology in the field, please contact us. Happy to reach out to them. Happy to have them on the show. Right now, it's a small world. But the lithium price has rebounded. All these lithium stocks are starting to go up. Last sector we'll touch on is more energy, oil and natural gas. Oil is crazy undervalued as a commodity compared to all the other commodities. We're not seeing a destruction in oil. We're also not seeing peak oil demand. The world needs oil. It's here and now. I think the big change in the market in the last 10 years is that the US we've built out our own infrastructure, right? So there aren't these, I think, supply shocks that could come because countries cut off the US. The US can handle it. So at these current prices, companies are making money. They're very good at returning capital to shareholders. And when the price goes up, they can easily turn on growth. Right now, it's all about looking at the companies that can maintain their dividend, which is 5 to sometimes 12%, and you get paid to wait while these stocks have done very well. You look at the oil price chart, and it's gone down for 3 years. It just has. It's grinded lower. You look at XLE, which is the major oil producers, the ETF that follows the oil stocks, hanging right around its highs, has been for the last 3 years. So that's telling you something that these stocks seem to be very healthy, even at these lower prices. I really like the setup in oil. I've been buying some of the mid-size producers, some of the ones that we've had other analysts on that outline M&A transactions that the market hasn't digested either. That is immediate growth that takes a while to filter through. I think there's a lot of opportunity in oil. Natural gas, I'm going to leave because I'm not a trader and it is too volatile for me. It was $9 a couple weeks ago. It's $3 now, all because of cold weather. I don't predict the weather, so I'm focusing more on oil stocks.
That's why they call Nat Gas the widowmaker. It's hard to trade, but it is volatile. I like companies that have a nice blend, though, of nat gas and oil. And I'll throw out a couple ideas just because it's nice to have a company that's internally hedged. And to the point Cory just made, some of these M&A deals have not been properly factored in by analysts yet. So you got a chance as a retail investor to get a jump before the street does. One idea is Crescent Energy. They took over Vital Energy recently. I don't think it was understood well. And that company is, I think, very undervalued for what they have. The pro forma company is going to really surge. So Crescent Energy. Another idea I'll give you is SM Energy. SM Energy just took over Civitas, and that was not well understood either. Because of that, you have a chance right now to get in before the company is realized for what it will be producing and the growth and the number of well pads they'll drill. And I'll give you a royalty name in the space. Venom, VNOM, is Viper Energy. If you've heard of Diamondback Energy, this is the spin out of their royalty asset. So if Diamondback does well, Viper does well. And Viper also bought Sitio Royalties last year, and nobody cared. But you should care as an investor because it means they're going to have more revenues coming in. So those are three names in the oil space that are all three in the middle of digesting their mergers. And I don't think the valuations reflect where they will go. And I'll throw in a Nat Gas name or two just as a kicker here. Antero Resources for Nat Gas is a solid company. They'll do well the better the Nat Gas price does. And I'll give you Range Resources. Range Resources is another solid company. Again, if you believe that Nat Gas can go from the 3s to the 5s, those companies will benefit greatly, and they all do have a nice dividend structure in place.
Play Oil is one other one. More of the mid-tier, recently brought in a new investor that really wants them to grow, recently raising money in Israel for more growth, and their stock's been doing very well, but that's in Play Oil. They seem to have the cash available and shareholders that are pushing them towards growth. So again, just like with all commodity investing and resource investing, as long as the commodity or resource price doesn't collapse on you, then you can stick to these bull market narratives, especially now. It is a bull market. Again, but just one thing, I've been around this sector for a while. When the price starts going against you, or you start seeing certain sectors break down, as much as you like the story, take some off the table. You can't control the price. And as good as the story might be, if its underlying commodity is falling, you're not going to do well. You're probably going to be able to get it for cheaper later on. Doesn't mean that it's a bad story, just means that the market's going against you. However, right now, everything's wind at our backs right now. So in a way, be invested, rotate that money from winners into some of the ones that have lagged, or ones simply that you see a disconnect in their very simple metrics of how you might value them, and buy those and ride them higher. But then constantly be checking what their valuations are, because some of these valuations do get ahead of themselves. It feels great. Take some of that money off your table because you can use it. You can redeploy it elsewhere. And some of these stocks have gone vertical. I'm sure there's still some multiple upside, but that 10x that we just saw from some of these stocks, it's hard to argue that it's going to do that again, but there is opportunity out here. So look, I hope you all enjoyed this. Thank you all for coming here. Unfortunately, I think we're out of time. So if you want, Chad and I are going to be around this whole conference. Please flag us down, get our contact information, send us emails, come to our website. Our emails are all over the website. Subscribe on our podcast, follow us on YouTube. That's where you get all our information. It's all for free. We try to give you the honest tale of what's going on in the resource sector in a whole bunch of different commodities. So everybody, thank you.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
In mining, the difference between a good project and a great investment often comes down to one thing: visibility. Tara Hutton is a Sweden-based online mining investor platform built to make the invisible investable. Because a great project without a story is just data, drill results, spreadsheets, and technical reports that never fully connect. And a great project that isn't online might as well not exist at all. Tara Hutton brings mining projects into the digital spotlight, combining data, narrative, and context in one place, so investors can see not just what a project is, but why it matters. Whether you're evaluating early-stage exploration or more advanced development assets, Tara Hutton helps turn complexity into clarity and information into insight. Visit Tara Hutton online and start discovering the stories behind the data.
Hey everyone, I'm Corey Fleck and I run the Corlin Economics Report, the longest running radio show and podcast covering market moves in the resource space. If you want daily commentary from the top analysts and fund managers in the resource sector and the broad markets, be sure to search the KE Report in your podcast player or visit the Clear Commodity Network site at clearcommodity.net. All right, welcome back. Continuing to listen to the weekend edition of the KE Report. And now stepping away from that Las Vegas Money Show, we are going to be talking oil and natural gas as we're chatting with Dan Steffens. Dan is the president of the Energy Prospectus Group and joins us every month to recap what's going on big picture price-wise for oil and nat gas, as well as some stocks. And the theme of the stocks today is going to be more on mergers and acquisitions, looking ahead to some stocks that Dan thinks has some chances to run once these deals close. Dan, I do want to start with oil, though, because oil's been rebounding very nice this year. So far, we're about 2 months through, but quite frankly, in December, oil was down in the mid-50s. Now it's in the mid-60s, back to price levels we haven't seen since late September. Big picture question here, Dan. What's driving this rebound here and now?
Well, it's almost totally what's going to happen in Iran next. Obviously, Team Trump is trying to negotiate something with Iran, but I think they're just delaying. I think the whole purpose of the negotiation is just to buy them more time. But, they're not going to agree to all his demands. And, the buildup in the area, the military buildup there, sure look like to me they're going to attack. I mean, we're recording this on Thursday. By the time you do this, come out with this, maybe the bombs will be falling on Iran. I don't know, but Trump's losing his patience in it for sure.
Well, Dan, maybe bring in a little more of the macro as far as the inventory builds, anything that's happening as far as OPEC, anything else moving the markets outside of that geopolitical part.
Well, all year, EIA has been telling us that the global oil market is oversupplied, but it really doesn't show up in the inventories. I mean, the Wednesday inventory report from EIA, yeah, there was a big build, but our crude oil inventory is still below normal for this time of year. Gasoline's a little bit higher. Distillates 7% or so below normal for this time of year. The world's economy runs on diesel. It doesn't run on gasoline. We drive around our cars gasoline, but the big equipment and stuff that builds things for everybody is diesel, and also our farming equipment. Once you get into the spring, there's a big demand for diesel for planting during the planting season, so that'll come around. But they've been advertising this the oversupplied oil market. And, I think for IEAs, I think it's just kind of political. They want to keep oil prices as low as possible for as long as possible. But I'm kind of surprised that EIA is going along with that because, we're just not seeing it in any inventories. I mean, you can say it's floating around in ships, but if those ships are can't sell their oil because it's banned because of sanctions or something, well, that oil's not really in the market. And then also both the Chinese and the U.S. are refilling our strategic petroleum reserves. Well, the oil that goes in the strategic petroleum reserve is not available for commercial use. So that's only for, a dire emergency or something. So that's out of the market. So I think Joseph Shatner, I think we agree on this. I think oil prices today are a little bit ahead of themselves because of the situation in Iran. But I think the fundamental supply-demand fundamentals are going to cause oil to get to 70 or 75 by the end of the year. I mean, that's what I'm pretty much basing my forecast on.
So, Dan, if both of these agencies are saying that we have too much oil right now, are they saying that it's a supply problem then? Is the U.S. pumping too much? Is OPEC pumping too much? Or are we just not seeing massive demand growth?
Well, they're saying that if all the supply was available to commercial, yeah, we'd be oversupplied. But if half of it's going into strategic petroleum reserves, and then a big chunk of it's in ships that can't sell it to anybody, well, then that's not really going into commercial inventories. So in demand, we're in a low period of demand right now. Once you get into the spring, the driving season, then the demand picks up. It takes more black oil, more crude oil to make summer blend gasolines in the United States and around the world, I guess. But, and then there was this fear that Venezuela was going to pump all this oil. Well, that's not going to happen. I mean, be a little bit of increase. They've reduced some of the legal requirements for getting into Venezuela, but that's not going to happen overnight. So I think once we get a few months down the line, people are going to realize that the market's tightening up. Now, we have the OPEC meeting on March the 1st, and it's anticipated that they're going to say they're going to start increasing the quotas starting in April again, like 140 something thousand barrels a day, which, compared to the world's oil market of 105 million barrels a day, that's, not even a 1%. one-tenth of 1% increase. So there's only like three countries in OPEC. It's Saudi Arabia, UAE, and maybe Oman that can increase production at all. And I don't think they're going to do it just to reduce oil prices for Trump. So, we'll see. But most of the cartel countries cannot produce up to their current quotas anyway.
Yeah, it's a good point. It's one thing to have a quota. It's another thing to actually meet that quota with production. And so two different things. Well, that's a take on the oil market. Let's also quickly cover nat gas. Nat gas is obviously seasonal. It's weather related. It's regional. The nat gas in Europe is much different than the nat gas in Asia, which is much different than the nat gas in the US, which is different than the nat gas price in Canada. So make sense of it for us, Dan. It's been a wild roller coaster ride all year. It's always a volatile market, but a lot of it was based on the weather patterns earlier in the year. Now that's shifted. How are you looking at nat gas for the balance of the year?
Well, nat gas is crazy, and then trying to model some of these companies for me is difficult because I know that some of them were able to sell their gas into the Henry Hub regional market down there. The price spiked over $30 per MMBTU during that winter storm Fern, I think was near the end of January. And if you have really good marketing teams, when I was at Hess, we actually sold some gas into the New York regional market at $60 per MMBTU, and the gas price was like $5 or something. I actually thought when one of my clerks brought the check in to show me, and I said, they must just have the decimal point in the wrong place. And I talked to our marketing group and said, no, we were able to get some gas into New York, and they paid us $60 for it. So, these utilities, when you have a real significant weather event, that there's a huge draw on their inventories in that particular region because their storage locations located all over the country. And, let's say a big storm hit Chicago and they are depend heavily on stored gas. And that utility gets calls on, they have to keep the pressure up in the lines. They're going to go out in the market and pay whatever it costs in the spot market to get that gas. So it's hard to see how these prices in the futures market, the price you see in the paper is a front month futures contract. On the day we're recording it, it's already the April contract. Well, everybody knows, and all the futures market traders, they know we have enough gas to make it through April. That's one of the lowest demand periods of the year. So that contract's down. But when you look out further on a futures contract, I look at the December 26 futures contract, and it was trading for $4.31. And so if you're a gas producer, you can go in the futures market and lock that price right now. You can lock in that price by buying the futures contracts or selling the futures contracts. Anyway, so it's really hard to evaluate where gas prices are going to go. But the U.S. gas market, and to some extent the Canadian gas market, demand is increasing significantly because of LNG exports and also because of power demand. And the portion of demand for power demand is going to really start ramping up after we get past 2026. So I think that the macro environment for natural gas is very strong. Anyway, so you just got to look at the production mix of each one of these companies and see what kind of hedging programs they have and stuff like that.
Well, Dan, let's just look a little bit more at a longer term outlook here, because I think many traders or investors are kind of like I am, where you watch these wild swings in the natural gas market. And it wasn't even that long ago that we had a major weather event just last month, and prices spiked. And then as the contract rolled over, everyone thought the prices would stay high, and the prices came right back down. They're even lower than where they were before that weather event. But longer term, what makes sense to you in terms of pricing? Is it in the $4 range? Could it even hold in the $5 range? Or quite frankly, is, let's say, $3.50, is that more reasonable?
Yeah, I think you got to set the range. And if you're going to evaluate a company or a drilling program or something, you got to say, okay, what's the low? What's the high? How big could this go? And a lot of these companies, they'll put out, okay, if gas is $3, this is what our cash flow is. $4, it's what they show you different price ranges. But what I'm using in my forecast are, for next year, for 2027, I'm using $70 oil, which I think could be too conservative, and I'm using $4 gas, which I think is realistic. Now that's the average for the year. It's just like this year, the January futures contract was trading for close to $8 for a while. And then the next it rolls over to the February contract and it drops down to 350 again. And today we're looking at the April contract and it's 275 or something, like 280 right now. I'm looking at the screen. And think about it this way: if you're short that contract, so you got to either deliver that gas or you got to take it if you're long. So if you're long, then that gas is going to go into storage. And if you don't need the gas, if you're a utility, so you have a sufficient amount of gas to make it through that month of April or May or whatever, then you don't want to take delivery because you'll have to pay those storage fees. But if you're on the other side of that thing and you're looking out to the next winter and you think, hey, it's going to be really tight next winter, why don't we buy some contracts to take gas in December and January of next year? And that's why those are so much higher than the front month of the NYMEX contract. So it's really not a forecast, the NYMEX future in the forecast. It's just what you can lock in the price today for. And so you got the risk of not having enough or the risk of having too much, and that's what drives the paper traders really.
Well, and Dan, if we dive into the world of the energy stocks, as you mentioned, most companies aren't pure gas or pure oil anyways. They're a mix. They're a mix of oil, dry nat gas, but also natural gas liquids. And it's really that blend that gives companies an internal hedge, and they can play different things internally to balance the oil and the gas and the NGLs. So let's dive under the hood and talk about some companies that are massing up and they're growing. One company that we're going to discuss here today is Devon Energy, traded on the ticker DVN, and it is actually merging with Cotera Energy, traded on the ticker CTRA. And we've talked about Cotera before. Devon's a bigger company. Now it's becoming a much bigger company. This is one that you feature, but talk about, and this theme today is going to be, M&A deals and some of the growth in the sector. Talk about this Devon Cotera deal.
Well, the point being really that when these deals close and they create a much larger company, and Devon, this is a very big deal. This is going to move their production up to 1.6 million BOE per day, with half of that being oil, or 900,000 barrels a day of oil. And that makes them a major part of our supply. And the bigger the company, the higher the multiple that they trade on. I value companies based on what I believe is a reasonable valuation of their cash flow, future cash flows, of operating cash flow. And in the good old days, when this market kind of made sense, companies of this size, of the size of Devon, and to tell you how big, they're going to be the second largest producer in the lower 48. I think ConocoPhillips is just barely ahead of them. And they are going to be larger than EOG Resources. So EOG is currently trading about a 6.5 times operating cash flow, and Devon's only trading at about 5 times operating cash flow based on my forecast. And so when the deal closes and everything gets in line, you're going to see the Wall Street gang. They're going to revalue these companies because of their size. And we saw that recently with Whitecap, about after the merger closed with Varen. And there's a couple quarters under the belt now of the combined results. And also, these companies are announcing how much they're reducing their costs, their back office costs and their cost of pipe and completion. That completion cost for wells goes down because the bigger you are, you can get better contracts from the drilling companies and the oil field service companies.
So, Dan, if you're playing Devon right now, the stock is up, let's say, about 10% from when it announced this merger, and it was already trending higher since lows in the beginning of November. What drives it from here? Is it simply the closing of this transaction? Do you have time to still get in, or how would you time this?
Yeah, and I get Tip Ranks Premium, it has all the current analyst reports on it. I mean, up to the minute. It's as soon as the analysts file a new report on it, and they rated a strong buy at today's price. I think it's like in the mid 40s or low 40s right now. And when the catalyst will be, first of all, there's always risk that a deal won't close. And a deal of this size sometimes requires all kind of government approval and stuff before it can close. Well, then once they close the deal. But in this case, there's no risk of them not getting financing because it's an all stock deal. It's just a stock for stock transaction. And as a result of that, also because nobody's having to go get big debt to buy Cotera, Devon's not going to incur any debt. They're just issuing more stock. The balance sheet post-merger is going to be very strong, so they'll just, merge their two balance sheets and they get all the cash that that Cotera is accumulating now for selling their gas. Anyway, then after the merger, the companies always come out with much more detailed guidance. And that gives the analysts, energy sector analysts, and myself more confidence in their futures models. Now, on this particular one, Devon and Cotera were both in our Sweet 16 growth portfolio. And I've been following both of these companies for, Devon for like 20 years. I've been following them. And Cotera, just for the last 5 or 6 years, I've been following them. But I have a high level of confidence then in both of my models. So it was very easy for me just to add them together. I mean, they're pretty much, the models almost look exactly the same because they're both upstream oil and gas companies.
Well, Dan, to that point, if you look at their charts, they kind of look the same too. So they're both growth oriented. We've talked about them both separately before, but to the point you made about the street needing a little time to digest it, I think this is what gives retail investors listening to this call an edge, is that before all the pieces are well known, there's this kind of transition period, which is what we're in right now with Devon and Cotera. Maybe contrast that against the other deal you brought up, which is another deal we want to discuss on this one, which is the Whitecap Varen deal. That closed the middle of last year. Now the streets had a couple quarters to look at it, and you can see what the result was.
Yeah, and Whitecap already had a very good reputation, there's no doubt about it. They've been a strong growth company. Like I sent you that note this morning that they had production growth, and they've been doing acquisitions but very small, like property acquisitions and stuff, nothing really big. But they've had a good record of drilling success too. So they increased year-over-year production growth by 20.5% in 2023, then another 11.4% in 2024. And the Varen deal, which closed on May 12th of 2025, that was a huge deal for them, and it increased their year-over-year production by almost 76%. And then their guidance for this year, for 2026, that they've just put out, is that they're going to increase production by another 20 to 22%. So it's just a classic growth and income stock, and I like it. I put Whitecap was actually in our high yield income portfolio because it has a great dividend yield and it pays monthly dividends, which is nice. Our members love monthly dividends, and the yield is 5.5%. So you get a good dividend check, each month. And you've got this, upside. And I think there's, maybe another 30 or 40% upside in the share price. It's just going to go with, and their production mix. What is it? I don't know here, but they have a pretty good production mix. Oh yeah, it's 48.5% crude oil, 12% natural gas liquids, and then about 39.5% natural gas. And also, they have got some good contracts that they're able to sell their gas at NYMEX prices, not at AECO prices. So they reported some really good gas prices. That was a nice plus for them this last quarter. Anyway, just a good solid company. And Devon is too. I'm telling you, Devon is a very high quality operator. They're very highly respected. I think they have told the market that they believe there's $1 billion at least in synergy savings on drilling cost, personnel cost. A lot of times with these mergers, of course, a lot of people lose their jobs because you're going to reduce staff when you have just one public company versus two. It does add a entirely new core area in the Marcellus shale up in Appalachia. That's where Cotera got a lot of their production from. You may not remember, but Cotera was formed by the merger of Cimarex into Cabot, and then they just totally renamed the company. And that's how Cotera ended up with a lot of acreage in the Permian Basin and in the Anadarko Basin in Oklahoma, which is where Devon already has significant operations. So that's where they're really going to get the cost savings, is in the Permian and in Oklahoma. And they might put up for sale what they have in Appalachia. I don't know if when the deal settles, because let's say gas prices are much higher, that's going to be a very valuable package if they do put it up for sale.
Okay, so on this Whitecap, you're getting some income, 5-ish%, which is decent, but it isn't, I guess, on the high side of some of the energy companies that pay out up to, let's say, 10 to 12%. But you are getting that growth as well. Since the stock has pretty much doubled from last year, shortly after the deal was announced, how important are energy prices to maintain kind of where they are for this growth to make sense, or does this company have protection on the downside?
Yeah, I mean, they have some of their production hedged. Let me see. Yeah, they don't have that much, but they have some production hedged at some pretty good prices, but it's only like maybe 15-20% of their current production.
Would you like to see that higher then, Dan?
Yeah, and they're constantly, every time I look at these companies, they've added more hedges, it seems like, when they get the chance. Like, so say you get a weather-related event that, caused the price to spike if they can do it. But in the futures market, yes, it spiked in the January contract, but it didn't spike in the summer months contract, so they don't want to lock that in. So anyway, but there's a cost to doing the hedging too. There's always a risk that hedged it too low of a price and you give up the futures the upside too. So some people don't like that, but they have a strong balance sheet. I mean, Devon and Whitecap have really strong balance sheets, so they really don't need to hedge just to buy that insurance that the commodity prices don't go down. But anyway, and then they can adjust their drilling programs if needed to deal with lower prices too. But they put out there with pretty conservative forecasts that they're going to generate about $1.5 billion of free cash flow. So they feel confident that they got enough protection.
Well, Dan, when you think about M&A in the energy sector, it's actually been pretty exciting for the last couple of years compared to the space we inhabit more in the mining sector. There hasn't been as many of these caliber of deals. Now, there was a couple of years back the big deals with some of the major players in the oil patch, but even recently, we've talked on the show about some of the ones you've highlighted, like SM Energy or Crescent Energy, where Crescent is buying Vital Energy, SM Energy is buying Civitas. So and we talked about this when we were just in the money show in Las Vegas, that some of these deals, while they're happening, there's that disarray. Well, if you tie that into what we saw in Whitecap, now Whitecap's a lot bigger company, but if you look back at May of last year, it was still down at the lower part of its range. It was after that that it had the trajectory. So again, just for future M&A deals that we see in the space, or this time period now where some of these companies that we've highlighted on previous episodes are in transition, what other advice would you give to investors looking at these but seeing maybe some of these mergers, like if you look at SM Energy or if you look at Crest Energy, their charts aren't amazing right now, but could they eventually look like the Whitecap chart once people digest all of this?
Yeah, they could. And they announced fourth quarter results last night. Both SM and Crescent Energy did on Wednesday after the market closed. So this afternoon, I'm going to be updating my pro forma forecast for them. The Vital merger into Crescent Energy closed on December 15th. So it's been closed for a few months. And Crescent Energy reported decent fourth quarter results. I think that actually beat my forecast, but their guidance for next year was a little bit below. Now they've sold some assets, so that has something to do with the production going down a little bit. And they're going to get the sales proceeds from that. So that shores up their balance sheet. The good thing about Crescent, it does pay a decent dividend too. So that's something to keep in mind. Now, Civitas, the merger into SM, I really like that deal. And that's a pretty big deal. It creates like a top 5 largest producing companies. So it's a pretty big deal. Not close to what the size of the Devon merger, but it's still a very material deal and gives them a ton of running room in both the DJ Basin and in the Permian Basin. Those companies, those assets really fit together very well. So I like that deal quite a bit. So anyway, yeah, I just think, I think the big move is going to happen after they have one full quarter of combined results. Then you're going to see the stocks really move. But I don't think there's a lot of downside risk right now. And they all pay nice dividends. So
Dan, the one thing that just continues to, in a way, surprise me is XLE, that energy select sector ETF. Oh my, has it just taken off at the beginning of this year? And it's been almost the exact opposite chart over the last couple of years from what we saw from the underlying oil and even nat gas charts. It was continuing to trade in higher ranges, break out, and now it's really broken out. XLE is up about 25% just this year. What does that tell you about the interest in the oil sector? It's clearly not hated by these kind of moves in the stocks. But again, it wasn't being supported by broadly higher energy prices.
well, I've been doing this. I've said EPG since 2003, and there just kind of comes a point where it's just like you start to feel that people are going to say, "Hey, wait a minute, we're going to be needing oil and gas for a long time." And these companies are very profitable. They pay nice dividends. And and then they see a lot of times in commodity super cycles. Some people are saying we're now in a commodity super cycle. The metals, usually the gold, the silver, copper, palladium, they kind of lead the way. But then, the black gold joins the party. And you've got US oil production has peaked. It is going to be way down from in January. When EIA puts out their report and shows actual production for January, it's going to be way below because of weather-related deals. But it's not going to bounce all the way back either. We're just not completing enough wells now to keep production even flat. So, and the Permian Basin especially, but the U.S. oil production growth has been responsible for about 90% of the world's production growth for the last 8 or 10 years. So with U.S. production flatlining and then maybe actually declining, where is it going to come from to meet future demand? And think about this, like all the oil wells that are producing today are on decline. All wells deplete, start going down soon after their pressure starts to be declining after they go online. So if we've got 105 million barrels a day of current supply, well, 20 years from now, half of that production is going to be gone. So it's not like the current wells just keep producing at the current rate. They're going down. So you got to replace the depletion rate in addition to the increasing demand. And there's nobody forecasting now that oil demand is going to go down, and especially gas demand, natural gas demand around the world is going up at a rate about 3 or 4 times faster than oil demand. Natural gas is the future. It's going to be the number one thing for generating electricity for all these AI data centers and everything. There's just nothing that can ramp up fast enough to produce the power that these things are going to need. And electricity demand just keeps going up all around the world. And natural gas or coal, I even think coal demand is going to keep going up.
Yeah, there's definitely a big need for the electricity component. There's a big need for the heating and cooling component. But just based on what Cory asked you and some of your answer there, when you look at the XLE and the producers and the move they've had and the anticipation for eventually higher oil prices, as you expect this year, maybe up into the mid to high 70s, are the producers already pricing that in advance because the market's forward looking, or was this a re-rating that needed to happen? And if we see that move into the 70s, do these things keep blasting even higher than they've already moved?
Like, when we started this and we said, oil prices last quarter in the fourth quarter were pretty low. They were down in the 50s, right? We got all these companies reporting fourth quarter results that are beating everybody's expectations. And they're going, and so investors are going, wait a minute. The companies have adjusted. They're making money now. And now the oil's like in the mid 60s. Gas had a big spike at the beginning of the year, but it pulled back from that, but it's still a pretty decent price. And people are saying, hey, these companies are money makers and they're rotating money into. And I think the AI, bubble or whatever you want to call it, I think people are harvesting those profits and shifting it into companies that are actually producing real revenues. And the numbers are incredible on some of these companies, and I just cannot believe. I've been doing this for a long time, and companies of the size of Devon or even Whitecap, they should be trading for 6, 7, 8 times operating cash flow, and they're trading for like 4 or 5. I mean, so there's going to be a 20, 30% increase just to get them up to almost reasonable valuations. And, as companies get bigger, they get more secure. They have a bigger asset base. They don't, every well isn't a big risk for them, and especially the ones that hold a lot of running room because, we're eventually going to run out of $60 oil, and you're going to have higher prices, that's for sure, to, start drilling in the tier 2 areas of the Permian and stuff. So it just, I don't know, these companies just look like bargain prices to me. And I think that's what you're seeing. The money managers are just rotating into that. And I can always tell you too, the market's going to start picking up when I start getting new members, because we've had kind of a decent pickup in our membership.
I bet you have, Dan. And again, it's just been, in a way, I think still surprising just how well these stocks have done when the underlying prices have been moving down. Oil and natural gas have been, in a way, kind of in a downtrend. Oil for the last few years. And yes, it's recovering now, but still just back to prices seen in September. So there still could be a lot of work to the upside, but man, these stocks definitely not being ignored. There is money shifting into them. And valuations, well, I guess we're going to see how valuations play out here, because if the oil price keeps moving, then that's supportive. But if it does slow down again, you got to expect some sort of a correction in some of these stocks. But that's why I like when you focus on these story stocks and ones that have made recent acquisitions, recent mergers, and have these growth plans that actually make sense. So, Dan, we're wrapping it up here. Again, Dan Steffens is the president of the Energy Prospectus Group. You can click that link in the show notes on our website, in your podcast player, or on our YouTube channel. As always, just search the KE Report. And everyone, thanks for tuning in to this weekend show. Hope you enjoyed it. Keep in touch with Shad and I. We love hearing from each and every one of you. And thank you to everyone who showed up to that Las Vegas Money Show and said hi to us. Dan, thanks for your time, everyone. Have a great rest of your weekend.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.